9 out of 10 payments would be done with blockchain and stablecoins.
The system is now far, far worse than it was, so 10, 20 years ago.
Payments with stablecoins would be much cheaper or almost free.
We can't compete, so now changed the game, which was comfortably the hardest job I've ever done. The army was easy compared with that.
Sounds like not real, actually, you know, when you try to imagine everything. So we have here Nick Philpott, co-founder of Zodia Markets. Thank you, first of all, for joining and sharing your insights, because I'm sure it would be super interesting and I have some questions prepared here. So you spent many years in traditional banking.
Yep, 16 years before setting up Zodia Markets. Yeah.
And then you changed and you came into a digital asset sector.
Yeah.
Why?
I moved into digital assets almost in two phases, so personal and professional. Personal was down to my little brother, Chris. So we don't actually know the date of this, but what we remember is that Bitcoin was $6. And I went round to his apartment to watch a movie. And we sat down, he put the film on, and I couldn't hear the film because he had a row of computer towers whirring away. I said, "Can you turn these off? I can't hear what's going on in the film." He said, "No, they're mining Bitcoin." And he was yeah, correct. And he was a big video gamer.
Here in UK?
Yeah, in an apartment in Surbiton, South London. So he was a big video gamer. He was mining Bitcoin and then using the Bitcoin to spend in a space video game that he used to do. So that got me interested after he'd sort of vaguely explained what Bitcoin was.
Interesting story.
And yeah, so then I started reading the white papers, the yellow papers. That led me on to reading Vitalik Buterin's paper on Ethereum and so on and so on. So it sent me down the rabbit hole. That got me a reputation in the London trading floor at Standard Chartered Bank of being, sort of, I suppose, a crypto bore. You know, I talked to people about it and they wouldn't be interested. February 2019, Standard Chartered's relationship manager for Facebook met Facebook, standard meeting, and Facebook said, "We have a secret project. It's to do with digital assets. Do you have anyone who could help?" And they were reaching out to some of their relationship banks, one of which was Standard Chartered.
They were trying to launch the token or something, right?
It was Libra, yeah, exactly, which became DM. So that request percolated through Standard Chartered and landed on the desk of a gentleman in transaction banking called Max, who set up our sister company, Zodia Custody, and me. So he was on the transaction banking side, and in a bank, transaction banking is the bit that does payments, custody, cash, things like that. And me in financial markets, which is the sort of trading floor, which is lots of screens, people shouting on phones, all that sort of stuff. And the two of us met on a video call with Facebook. So he and I met in front of Facebook. We got to know each other, and about a year after that, 2020, he asked me if I was interested in helping set up a markets version of Zodia Custody, and obviously I jumped at the opportunity. But that's professionally and personally how I wound up in this industry.
But everything started basically as your personal interest, right? Because you saw this mining of your brother, and then you just were sharing those news with your colleagues during the coffee breaks or something?
Yeah, no, exactly that. And boring them all rigid. And they were all very kind friends because they pretended to be interested. Maybe some of them were, but so got a bit of a reputation. And I could already see that all digital assets is the migration of finance onto the open internet in the same way that almost any other industry that you can think of has done. So if you look at music, for example, we had LPs, then CDs, then we had Napster. So at university, I used to use Napster, so sort of not very legal, sort of not illegal anyway. And then we now wound up with something that's much more structured and legal, iTunes, Spotify, and so on. Newspapers would be the same. We still have physical newspapers, but now it's much more digital. They're competing with Google and Facebook and whoever else for advertising. And obviously they're competing with blogs and online news sources, Huffington Post, that sort of thing,
true.
BuzzFeed, on the newsfeed. So there are winners and losers in this migration. And I would argue that finance, because of the sort of technological changes brought about by Bitcoin or introduced by Bitcoin, finance is going through the same upheaval and the same migration that those industries have done.
It's a huge topic, and I hope we will discover more insights which you have.
For sure.
But looking back at your experience with Standard Chartered and in global markets, what lessons have you gained there, which you later used at Zodia Markets?
It's quite a lot. I mean, so I started out as a graduate. So I left the British Army in 2006. worked in the graduate program at Standard Chartered, so I had no financial background, none. I have 2 degrees, they're both in history. So completely nearly useless from a finance perspective. So I really had to start from the ground up. My first permanent role was working on the sales desk in Nigeria, in Lagos, covering local financial institutions, pension funds, embassies, charities, things like that.
It was online, right?
Yeah, so I was in the trading floor, trading on the phone, on computers.
Here in London, not in Nigeria.
No, I was in Lagos. I lived in Lagos.
Oh, really?
Yeah. So, and Lagos in 2009, 2010, it's useful to see a country whose financial system just does not work. So on the wholesale side, you've got huge infrastructure challenges. Internet bandwidth was terrible. They used to send us the corporate learning sort of applications on CDs in the post. Yep, serious. The guy would arrive and you have to learn about conduct or culture or something like that, and it's on a CD. For example, you go for dinner. If you're taking a load of friends for dinner, they don't bring a card machine at the end of dinner back in Nigeria in 2009 because the telecommunication system doesn't support credit cards because the load is too great for the infrastructure. Instead, they bring a money counter to the end of the table.
Okay.
And I used to wear suits partly to look smart, but also because I needed the pockets to carry the cash. Because the highest denomination banknote in Nigeria back then was the 500 naira note, which is about $4, or at least it was back then. So if you're paying for sort of 9 or 10 people to have dinner, by the end you're pulling out bricks of cash, and the waiter is putting this cash into a money counter. So you're sitting there like Tony Montana or the mafia.
What an experience.
Yeah, exactly. I think that's left me with a sort of a real visceral sense of where finance has left part of the world behind in terms of people being underbanked and so on. The challenges that you get in everyday life, if the things that we have here that we take for granted, being able to tap, pay, being able to wire money to each other instantly, if that does not exist, digital assets for me will help deploy that to anywhere where anyone has an internet connection, which is now a lot of the world.
Is it a kind of your also personal mission to help those economies which are still struggling, with payments, for example, to help them to move forward?
Yeah, no, without doubt. And that's particularly important now because there's a system called correspondent banking. So this is how money is moved around the world. Now, people think that money is actually on the internet. It's not. So here in the United Kingdom, for example, if you're moving pounds, it's moving around on a system called CHAPS, which is run by the Bank of England or UK Payments, or it's some centralized system. Fedwire is the United States one that moves dollars. And the wire literally comes from when it was created in, I think it was about 1918, when it was literally copper wire. It was telegraph based. And that's how money used to move around then. All of these systems are specific to their countries and they don't necessarily talk to each other. If you can overlay sort of the open internet onto that, then you can make it much more efficient. Anyway, because you have all these systems that don't talk to each other, you have banks which are members of these systems. So in the UK, we'd have Barclays, HSBC, and so on. United States, you have JP Morgan, Wells Fargo, and so on. You have to have, if you want to move dollars, then you have to ask a bank in the United States to move them for you. If you want to move Japanese yen, you have to ask a bank in Japan to move them for you, and so on. So you have all of this network of bank relationships around the world, which is how money is moved. For various different reasons, the correspondent banking system, correspondent, that means those banks are corresponding with each other, they're communicating with each other, that has retreated. So lots of banks have looked at various different countries, I'm sure Ukraine be included, for example, and said there might be some financial crime risks in this particular country. Maybe we as a business don't make enough money from this country, and that could be particularly true of smaller emerging market countries. So we're just not going to provide correspondent banking services to that country anymore. This process has been going on for about 20 years, to the point where in certain countries, you can have a situation where the entire banking system of that country is dependent on one bank. So I'll give you an example. So in El Salvador, where I went to in January this year, they have about 13 banks. Those 13 banks between them only have 2 US correspondent banks. And actually 12 of them have the same one. So 12 of them have one bank and the 13th has a different bank. If that US bank that covers the 12 decides El Salvador's too risky for us, we're going to withdraw services, then El Salvador can't move dollars. Commodities, mass consumer goods, shipping, all of this stuff is denominated in US dollars. So if you don't have an American bank that can move dollars for you, you're in serious trouble.
So isolated, basically.
You're completely isolated from the world economy. This situation has got so bad that in 2020, the Bank for International Settlements has asked various regulators to start trying to fix cross-border payments, which rely on this correspondent banking system. And they've made some progress, but I would say that the system is now far, far worse than it was, so 10, 20 years ago. And that's having real world impacts. It causes costs of sending money to increase, reliability decreases, the speed decreases, and that increases costs, which will be felt not only by companies, but by the people who deal with those companies.
And sometimes, as I know, you have this situation when, let's say, you want to send money from Ukraine to I don't know, Singapore.
Yeah.
And then you might have even few correspondent banks
Yeah.
right between your two receiving and sending bank.
Yeah.
And then they all have to talk. And as I know, the system how they communicate, sometimes it could be really old, like
With
basically
Swift.
like emailing or something, especially
Correct.
if they lost your payment.
Yeah.
And you want to get this Swift investigation or something, right?
Yeah.
Basically it's super old, right?
It is. I mean, it was originally created. It's called Swift.
Yeah.
The Society
Swift,
for Worldwide International Financial Transactions, I think, from memory. Swift is a messaging system, so it doesn't actually move any money. The messages that are communicated between those correspondent banks then results in the movement of money, which is not happening on the open internet. You know, Swift, when it was first created in the 1970s, was literally relying on telexes and it was pre-internet. I mean, the internet technically started, but it was really only happening in the US Department of Defense, which I think was where it was originally invented under DARPA. So it was an antiquated system, and it still is in many ways. And people might want to blame Swift. I don't think that's fair. I think it's actually the correspondent banking system as a whole. Swift itself, the messages are quite fast, but it's the banks that then have to interface with those messages. And also, to take your Ukrainian to Singapore example. So you have a bank account in Ukraine and you're asking someone to debit your account in Ukraine and credit someone's account in Singapore. Now, your Ukrainian bank may not have a dollar correspondence. Your Ukrainian bank communicates to another Ukrainian bank, which then communicates with its dollar correspondent. So now we've debited Ukrainian hryvnia, we've credited dollars. Let's say you've gone to Wells Fargo. Unfortunately, let's pretend Wells Fargo doesn't have a correspondent in Singapore, so it goes to JP Morgan. Yeah. JP Morgan then does the US dollar versus Sing dollars. You're going round the world across the Pacific and getting to Singapore. You get to OUB, for example. OUB, unfortunately, is not the bank to the person you want to pay, so they have to go to Standard Chartered that is. So what have you got? 2 Ukrainian banks, 2 US banks, 2 Singaporean banks. You've got 3 different time zones, 3 different payment systems. You've got 3 different holiday calendars, and you have 6 different banks worth of KYC AML screening.
And it's real. Yeah.
It's all real, any of which could throw up a false positive. Many of those banks sort of have outsourced shared service centers in low-cost jurisdictions that do a lot of that anti-money laundering screening. But let's pretend someone in a low-cost center reads your payment, goes, Ukraine, I think there's something bad going on there. I'm not sure what. So we're going to stop that payment and investigate and find out what's going on. You have no recourse to most of those banks. You could go and ask your bank, but if your bank isn't the one that stopped it, they can't get Wells Fargo to tell you what the problem is. Wells Fargo won't tell you because you're not their customer, and if they did, they'd be tipping you off potentially. So you wind up in this horrendous situation where you can't force anyone to release your payment. There's no one to shout at, and you just have to sit there and take it. And this is an unacceptable situation for global commerce.
Yeah, sounds like not real, actually, when you try to imagine everything and you imagine those payments going around and the businesses, work and internationally, and it sounds like not real.
It's dystopian. It's completely dystopian, especially when so many other things happen so quickly and seamlessly. And I think what this points to is there's a cost that I think wholesale financial services just doesn't appreciate. So I think in terms of 3 costs. I think most people think in terms of certainly 1, maybe 2. So the first cost is explicit cost. How much does it cost me to send the money? So if I send 100, if I only receive 99, I've paid $1. That's the explicit cost. There's the implicit cost, which is, let's say I've made a payment, but it takes 5 days. What if I put the $100 on deposit for 5 days? How much interest would I have earned if it wasn't tied up making this payment? So That's the implicit cost or opportunity cost. But the third one is the psychological cost, which is when you instruct a payment, it now feels increasingly like placing a bet. Is it going to settle today? Is it going to arrive tomorrow? Could it be 2 weeks from now? You don't know. And that's really quite uncomfortable for people psychologically. This is also the reason why, for example, you look at London Underground, the metro system here. In terms of pounds invested in London Underground and versus the improvement in the customer experience, things like cleaning the stations, rebuilding the stations, adding air conditioning was not the most successful thing. It was adding the screens that tell you how long you've got to wait until your train comes. The reason for that is that 3 minutes of unknown waiting time, when's the train coming, when's the train coming, when's the train coming, is far more uncomfortable than 10 minutes of known waiting time. Oh, the train's going to be here in 10 minutes. Yeah. I'll get my phone out, I'll put my headphones on, I might listen to a couple of songs. Exactly, I can relax. It's the same as the Uber map. Because before Uber, you used to stand at your front window going, where's the taxi? Shall I phone them? Am I going to miss my flight? Whereas now, okay, I can see on the map that the taxi is 5 minutes away. He's on his way. He's actually moving towards me. I'll go and make a quick coffee. And then I'll walk out like Kaiser Sose and the usual suspects. Car drives up. I'll literally open the door and walk in. Yeah. And it'll feel very cool.
So you really have that phenomena in payments, right? Then you call it what, psychological
cost. So explicit costs, implicit cost, psychological cost. We need the Uber map of payments that tells us exactly where the payment is, who we have recourse to, and can give us an idea of how long it's going to take, because then we just stop worrying.
So you identify a lot of problems actually in modern payments, and you recently raised more than $18 million, right?
Yeah.
Congratulations.
Thank you very much. I'm glad it's behind us.
Yeah, and then how do you plan to invest those money? So how do you want to distribute them to get most benefits?
I mean, top of the list is to make sure we have the right people. Stablecoins particularly, which is our speciality, are now very much a la mode. They are in the zeitgeist. They're very popular. So good staff in the stablecoin realm are now trading at a premium. That's the first thing you look to. Do we have the right team? Are there people that we could bring on to make improvements? And make sure that we're serving our customers well. That's number one. Number two, there's obviously investments in our systems. We're looking at adding third-party payments. Until now, we've been very much just first party. So if I execute a trade with you, I have to settle that trade with you and only you. I can't execute a trade with you and send the money to someone else. That's now looking like it could change. So we've got an opinion that we can do third-party payments with stablecoins. So we need the systems to be able to do that.
But you don't need additional licenses or permissions or just the
not
IT?
In the UK, as far as we can tell. So doing third-party payments in the UK with stablecoins, not cash, stablecoins, looks like it's okay. So the second one is collateralized lending. So lending dollars against Bitcoin. It's a very popular trade at the moment, and you need balance sheet in order to be able to do that. And then thirdly, we are now onboarding some quite large customers, particularly in oil, gas, metals, agriculture, shipping, maritime. So the size of the trades that they want to do are quite large. So we need the balance sheet enabled to be able to settle the trades that they want us to settle. Last but not least, we're looking at geographical expansion. So in many jurisdictions, in order to get domestic bank accounts, so you can have access to local clearing, the payment systems that I referred to earlier. In order to get that, and in order to serve customers in some jurisdictions, you need an office in that jurisdiction, you need a license in that jurisdiction. So that often means you need a member of staff, like a money laundering reporting officer or a senior executive officer. So we'll be spending some of the money selectively on markets where we think there are big opportunities. Brazil would be kind of top of the list, along with places like Mexico, Nigeria, and so on.
So Africa and LATAM is like your next destination?
Yeah, actually, but sorry, I should add Asia as well. So we specialize very much in Asia, Africa, and the Middle East. That's through our parentage. But I was recently in Latin America. There's huge opportunities there. So we've got a couple of partners that we're looking to do some things with. But generally speaking, I would describe it as the global South. Probably, and friends, maybe, if I sort of stretch the term a little bit. So Latin America, Africa, I would argue we're already in the Middle East. We have an office in Abu Dhabi Global Markets in the United Arab Emirates, and Southeast Asia, potentially Northeast Asia, we shall see.
So basically, if we sum up what you say, people IT development
Yep.
and more offices, but I don't hear like more licenses, more compliance. So you are like
Yeah,
fine
no,
here.
I would describe it as people, platform, presence.
Presence.
You know, where are you present? And in certain jurisdictions, you cannot get local banking without having a presence, without using that presence to get a license. In the United Arab Emirates, in Abu Dhabi Global Markets, you can't get a domestic dirham, that's the local currency, bank account unless you have an office and you get a proper license. United Arab Emirates is one of the fastest growing markets in digital assets in the world, has a fabulous regulatory regime that's been around for a long time, particularly in Abu Dhabi Global Markets. And if it's not too bold for me to say, a very impressive regulator, very responsive, not a pushover. You know, they're a credible regulator, but also nice and flexible. So when, for example, we sat opposite the FSRA, and there are a couple of things in our business model that were just not really things that they'd seen before, or not really things that they'd contemplated. I think they were thinking much more in terms of big exchanges that are virtually integrated, like a Coinbase, for example, where you have exchange and you have custody all in one. We're separate. So we have a sister company that does custody. We use other custodians as well. So we are non-custodial. It's a bit weird for them. But to the FSRA's credit, they said, we'll go away, have a think about how you can fit. They came back, I think, 10 days later and said, here you go, here's a few ideas. And that's exactly what you want to see from a regulator. You know, credible, not a pushover by any measure, but with a degree of common sense and flexibility. So sorry, I've really sort of double clicked very much on the UAE, but for us, it's one of the most exciting markets in a very exciting region.
Because of the regulators are open to cooperation.
So there's partly that, but also you need the sort of the magic three things. So you've got a good regulator with a good regulatory framework, number one. Number two, you need to be able to get bank accounts. So I know, for example, in Poland, this is a continuous problem for digital asset companies and fintechs to be able to get bank accounts.
It probably will not change for another 5 years because of the new government. Yeah,
we shall see. And then thirdly, you need a market that actually where there's client demand. And the UAE, it's got a good amount of wealth. It's got a very young population. Young population is engaged with new technology, and that's both at the leadership and in just the population at large. But also, it has a very international population. So it has Ukrainians, Russians, Brits, French, Americans, Indians, Pakistanis, people who are sending and receiving money all the time.
Yeah, it's like a kind of like a middle of everything, right now. Like it's getting because you have Europe here.
Yeah.
You have Middle East, you have Asia, and it's like a kind of connecting everything.
Correct.
Yeah, and they make you, everything, like they try to help you when you do business.
They really do. Yeah.
Do they listen to you? Like if you come to regulators and some banks, do they listen to you or?
Yeah, they do. And the banks are warming up. That's probably the weakest part of their sort of setup. But the government certainly listens. No question whatsoever, and the regulators certainly listen. And everything's it just works. I had my bank account set up in the UAE before I'd even arrived in the UAE. I arrived in my apartment, and there's the letter with my bank card for the UAE was sent to my address in the UK.
It's traditional bank. It's not digital bank or
normal
bank.
Normal bank. Yeah, normal bank. So I got my credit card. I got my bank card before I'd even arrived. Things like your medical, it's just done so quickly. Finding property super easy. Finding office space is super easy. So I can't sort of praise it enough as a jurisdiction and as a region.
And you have a license there also?
Yeah, we do in Abu Dhabi Global Markets. Dealing in investments as principal under the virtual asset guidelines.
Do you need any more, or in that area, or enough?
Not at the moment. We have a security token dealing license in Jersey, the Channel Island. So in the fullness of time, we may try to add that capability to Abu Dhabi. But we'll see. We'll see. I mean, at the moment, our real objective is to start adding more currencies. And in order to add more currencies, there are certain jurisdictions where we might need more presence.
Yeah,
that's that last of the P's. As I said, probably the next ones to look at would be places like Indonesia, Malaysia, Brazil, Mexico, Nigeria. be sort of top of the list. Kenya as well.
So if we talk about the banks, compare it to a year ago, how big banks and institutions, they changed their attitude towards using digital assets and stablecoins?
I think the big banks are still mostly nowhere. I think they're mostly miles behind, which is staggering. You go and speak to a lot of the banks, they are usually engaged in either some sort of sandbox and sort of tokenization of a bond or a carbon credit or a private credit or something like that. The question that I have for all of them is, what are you paying for those assets with? The response is usually sort of mumbling something about cash. Now, the problem is if you tokenize a carbon credit, for example, you can get the carbon credit to settle in minutes. It'll move as fast as email. It'll move at weekends. It'll move at night. Move when you want it to. But the cash, if the cash doesn't arrive until the day after tomorrow, you are where you've started, because you've got to go at the speed of the slowest, the slowest thing in the trade, which is cash. So my attitude is, until you fix cash, everything else is a bit of a waste of time, because cash is a component in every single market, probably with the exception of stock borrow lending, where you have asset versus asset on both sides. So security versus security, for example. And I think a lot of the banks are just still sort of nowhere. What we're finding is that it's a mixture of quite small sort of crypto-friendly banks, which in many cases are really just glorified payment service providers and struggle for access to clearing, correspondent banking system. And actually, there's probably a couple of really strong regional banks as well. BTG Pactual in Brazil is probably one of the leads out there in terms of adoption, attitude, posture. Looking east, DBS certainly out there. And amongst the sort of tier one banks, Standard Chartered, our parent, is no question it's an outlier in a positive sense. There's public knowledge. It banks Circle, it banks Coinbase, it banks OKX, it banks Paxos, which is the issuer of the PayPal stablecoin, and it banks us and various others. So it's a very credible actor, and it would be great to see more tier one banks start to come into, or to at least just start to take a sensible approach to this asset class, rather than just looking at it and recoiling in horror and going, oh, well, it's all just illicit finance, because they've managed to read the front page of the Financial Times a few times. I think they should actually do their research.
So you have this, I would say, maybe weird situation when you have crypto and fiat part together. So you are part of a big bank.
Yeah.
And from one hand, when I was thinking about this, I think, this is the advantage, because you have those rails.
Yeah.
You can use them. You have the connections. You have probably some potential customers. You can talk to them, right? So you have already some reputation and advantages.
Yeah.
But on another hand, it seems that you might be limited because, there are some policies which you have to stick to.
Yeah.
Can you elaborate more, like, how do you feel being a part of Standard Chartered Bank?
Well, or just any tier one bank. I'll generalize to spare Standard Chartered's blushes. There's definitely positives and negatives. So the negatives, obviously there's just a lot more bureaucracy. So say if you're running your own startup, you can make a decision in the morning and probably execute it late in the afternoon.
Yeah. And we basically, now we are onboarding with Zodia Markets, my company. And I know that the process is quite hard.
I know.
But you told me about that.
For which, let me, on the record, apologize for
all good.
No, you're absolutely right. So we inherited the same Know Your Customers, KYC, Customer Due Diligence, CDD, and sanctions policies as Standard Chartered. That's positive in the sense that if you can pass our KYC, then you should be palatable, you should be acceptable to any bank on the street. So it's almost like a challenge. If you can pass us, you can pass anybody.
That's what I'm telling to my team, because they told me that this is so hard. They require like a huge list, and then we have to go to find some local lawyers who will help us, to check the documents. And then and indeed it was like a challenge, because I understand that the team basically they can learn a lot. They can become better and then use this experience somewhere else. So you don't have to apologize, because I see it's like you're partly doing my job. I have to challenge my team.
It's a video game.
But,
this is where you're at boss level now.
Yeah, right.
Actually, no, the Swiss banks are probably boss level. That's sort of 1,000 questions. Oh my God. No, you're absolutely right. So we're doing things the right way. So there's no question there. So that's very positive. That said, when we're dealing with fintechs such as yours, you're right. Sometimes the reaction is, my God, no one else in crypto asks us for this. And you go, well, yeah, but we have a slightly different approach. Whereas, for example, I'm onboarding a steel company right now, and the steel company deals with major banks. So I sent them the onboarding list. They turned it around same day. Oh, we have all the documents the banks asked for. There you go. Oh, yep,
Okay.
yep, done. Okay.
But the process is different comparing to financial institutions like mine. So it's
slightly different, but the core is the same. So you need all the documents, you need them certified by a lawyer. And it's a sort of relatively standard sort of set of documents that you would tend to ask for: source of wealth, source of funds, proofs of address of the ultimate beneficial owners. Anyway, and so on and so on. So that's a positive and negative. Again, the positive is that as a fintech, when we're approaching some very large institutional customers, the fact that we have the big bank ownership and the fact that we can demonstrate that we do things in the right way, that makes it much easier for them to go to their risk committees and say, yes, this is a 50-person fintech that's only, what are we now, 3, 4, depends how you count it, 4 years old. But this is a credible player and we should be okay to onboard with these guys. Other problems is the speed of decision making, no question. Getting things approved within a big bank is a challenge. So, for example, our collateralized lending product, a product that in your business, if you decided to do it, you'd probably have been able to roll it out in 6 weeks. I think it took us at least 6 months because we had to go through one committee, another committee, another committee, another committee. That's definitely a downside. And the speed of being able to get access to things like new bank accounts and stuff like that, that takes an alarmingly long time. But if I had to sort of put it into the balance of benefits and pitfalls, the positives and negatives, positives definitely outweigh the negatives, no question. And being a hybrid actor in digital assets, as I said, most crypto companies have access to quite poor banking, which means that they are limited on the size of transactions that they can do, not because of their balance sheet or anything, it's because of the banks that they're using. Those banks don't have access to those financial systems that they need. Our access is A grade. So almost what we aspire to be is to be, that foundation layer where we can just provide low cost, fast, reliable services and let you guys do what you specialize in doing, which is delivery, client interface experience at the mass consumer goods side, and you can innovate on top of us.
Yeah. And how independent you are in terms of making decisions, and because there is something which you do as Zodia Markets, right?
Yeah.
And there is something which you have to aligned with the bank.
Yeah.
Like how independent you are in your decisions.
We actually have quite a significant amount of independence, which is remarkable, really. So we're overseen by our board. The majority of our board are Standard Chartered people. The chair is a Standard Chartered person, and it's quite dominated by Standard Chartered, as it should be. So that's the supervision that the bank's regulators want to see. The other sort of restriction that could have happened would be systems-based. So bank systems aren't fast enough to do digital assets. Digital assets settle T0, as in you execute today, you settle today. Now, a bank, when you speak to a bank, will think of T0 as I execute now, and at the end of today, we'll settle. Whereas we have customers who, if we haven't settled in 30 minutes, they're on the phone or on Telegram. Where's my money? So, okay, calm down, it's coming. Which is great because it keeps us, on our toes. And ultimately, this is where all financial services is going to go. In a day where you can send a message, send an email, move money on retail sizes instantaneously, you should be able to settle wholesale trades just as quickly. It's a shame that we can't. But the bank systems are just not there. And I would say that's not just a Standard Chartered thing, that's all banks. So let me illustrate. In 2018, I was in the electronic trading team, and we did a Bitcoin test trade with a counterparty. And I don't know if is it Indiana Jones and Raiders of the Lost Ark with the giant ball rolling behind?
Yes, yeah.
It felt like we'd rolled a giant ball into the bank systems because it broke everything it touched, including the general ledger. What the currency code didn't break the decimal places, Bitcoin has lots of decimal places, broke the rest. that was when we realized that creating a digital asset trading business was going to be very, very hard, because we would have to retool and amend the bank systems. And these bank systems are massive. I mean, they move trillions a year. So changing them, it's sort of like changing an engine whilst the car is still driving, is hugely dangerous, as you'll know, from a technology perspective. The bank started on that, but that's what meant that Zodia Markets and Zodia Custody was set up in parallel with different systems that were designed for T0 and for the speed for 24/7 trading. Standard Chartered has continued to work on its systems, and you'll see in the press they launched Bitcoin and Ethereum trading earlier this year, but the settlement there is still T+1. You execute today, you settle tomorrow. So it's taken them 7 years to get live through regulators, through all the various risk committees and all those sorts of things, and the system changes, and they're still T+1, and that took 7 years. And indeed, I was at a conference in Sweden earlier this week talking about post-trade settlement, and that industry is still grappling with going from T+2 to T+1. And I'm sitting in some of the audiences sort of scratching my head, sort of thinking, well, hang on a minute, digital assets are already T0. What on earth are you guys, how is this hard?
Yeah.
But again, it's that trying to move a super tanker. So yeah, hopefully we are, and this is how Standard Chartered, I believe, looks at us, is we're helping them learn how you can run a business that's 24/7 and almost instant.
So they basically, they watch you and they try to, like, do you share some experience with the team already? Like, you have some system between you, like
just chats, meetings, personal relationships. What's the analogy? I suppose we're the monkey that they fire into space first before they send Yuri Gagarin up there. So
if they survive.
Yes, exactly. Or Laika the dog, pardon me. If
Right.
I remember, remember my analogy.
If you survive, then we will listen to you. But do you think like they see some risks for them? I mean, the bank.
Yeah.
If you complete your missions within the company.
I would argue it's a nice problem to have, because then at least you have a company in the group that has already achieved that. Whereas, a bank, like many of the big banks here in the UK, the high street banks, the big clearing banks, who, as far as I can tell, are asleep at the wheel. They seem to be nowhere. So if we get to the point where Standard Chartered has seen us flourish and become successful, and now has a very nice problem, do they buy us back in? Do they spin us out and cash in? Do they try to create a partnership?
No.
It's nice to have options. Standard Chartered is buying optionality, whereas the big clearing banks here, they're just going to be sitting there going, okay, well, we can either repeat what Standard Chartered did with Zodia Markets, in which case that's going to take us 5 years, or we're going to have to buy, which is going to cost us a fortune, or we're going to have to try to make the changes to our internal systems and try to get to where Standard Chartered's already got, which is going to take us ages and cost us a fortune. None of those are good options. And this is it's the nature of things. Now, people might think, well, Standard Chartered, it's a 175-year-old British bank. It's not really a bank that I would associate immediately with innovation, perhaps. My argument there would be Standard Chartered specializes in Asia, Africa, and the Middle East. And it specializes in frontier markets. So, until a few years ago, it was the biggest foreign bank in Afghanistan. It has, it used to have, till again recently, branches in Sierra Leone. It's the biggest bank in fact, it controls the entire financial system of the Falkland Islands. It's the only bank. So it's in some quite courageous jurisdictions. As a result, it's always been at the forefront in many markets of creating a market. So, I don't know, pick some random stuff. In Vietnam, if you're creating a repo market, or if you're moving into bond trading in Saudi Arabia, it's helping develop markets. The same is true of digital assets. The only difference is that digital assets are across a digital frontier rather than a geographical frontier. It's still an emerging market. It's just emerging from a digital plane rather than a geographical one.
Do you agree with the statement that in 5 or plus years, 9 out of 10 payments would be done with blockchain and stablecoins? Or you think it's too close? I
think that's probably too big a number, because I think there'll still be a period of transition. I definitely think stablecoins will be the most widely adopted. They already are, and I think they're going to accelerate away from the pack. Tokenized deposits will work, but only for particular banks to make their existing clients stickier, so to make them more loyal. Because those tokenized deposits will only work within that bank's network, or if they want to make a consortium, it might work in a consortium in a limited manner. The problem is the moment you send a tokenized deposit out into the wild, it won't trade at par, meaning if I have, let's think about a European context, if I have Bank Piraeus coin in Greece, that will not, which is euros, that will not trade at par with BNP Paribas coin, which is also euros, or ABN AMRO coin. They'll be priced differently, which gets us back to the period of sort of the 1870s in the United States of wildcat banking. I don't know if you're familiar with this.
Yep.
Where all of the bank branches had their own banknotes. Yeah. And if you were in Texas and someone gave you a South Dakota or Minnesota banknote, you discount that, and someone in Minnesota would discount the Texan one, and so on. So you have basically this continuous market of money. That's the first problem, or the first alternative. Second one will be central bank digital currencies, which I just don't think will work because they might have a domestic retail use case. So particularly in China, for example, yuan. But in order for them to work cross-border, you'd have to network them up. So, and I would argue that CLS has been trying to do that for the last, what have they been doing? About 23 years. CLS networks up central banks so you can settle foreign exchange. They've managed to network up, I think it's 18 currencies so far. So there's 180 currencies in the world. So they'll finish all the currencies in the world in 200 years' time. It's not going to happen. The last one is tokenized money market funds. The problem is that in order to distribute them, you need a securities license everywhere where you want to distribute them or to hold them, which just means there are a lot of barriers to those being able to scale outside of sort of traditional financial market infrastructure like collateral movements, which is a valid use case, but for cross-border payments, to your question, I just don't see it happening. And last but not least, I think there's just going to be a lot of inertia. There's a lot of people and a lot of banks that will just carry on using the same system that they're still used to.
Right. But they are kind of waiting for some use cases, like successful cases. It seems like they are open, they are listening. Like Zodia Markets, like probably they are watching and they are interested. They may be afraid a little bit.
Yeah.
But they are carefully like waiting for maybe even waiting for the success.
Potentially. I mean, I think it's just still a lack of knowledge. So we know corporate treasurers who are now starting to use stablecoins more actively. But those corporate treasurers all say, I do not want my name in the public sphere because I don't know how my tier one bank is going to react if they find out that I'm effectively using a stablecoin, which is a competitor. So let's say, for example, I bank with two of the big US banks and they find out I'm using stablecoins. Many banks would just take the view, oh, that's crypto, that's probably illicit finance, so we'll close all your accounts. So many of these big corporates just are already active, but won't tell their banks. So as a result, the banks are carrying on thinking everything's fine. What they're gradually going to see is deposits are going to fall and correspondent banking revenues are going to disappear. And then in 5 years' time, to your question, they're going to be standing there wondering where it all went.
Yeah.
So I do think there will be a significant migration, but I think it was 9 out of 10. I'm not sure. I think for certain corridors, you're definitely right. So some countries where digital assets have been so heavily adopted, Ukraine, Nigeria, Turkey, Brazil, potentially Mexico, places like that. Philippines would be, that's a good one. UAE. I could see that their payments will have massively moved over, but other jurisdictions, particularly, somewhere like the euro, and this is not a criticism of the euro, it's actually a praise. Euro payments kind of work. SEPA works, Target 2 works, it's pretty quick. You can get a euro bank account reasonably easily, unless you're a fintech.
And you have SEPA Instant also, which
SEPA
is like...
Instant, Here in UK, we've got CHAPS. So you've got a lot of systems that are great, and doing cross-border payments generally is okay. You've got quite sophisticated banks that can serve you. But if you're in somewhere like El Salvador, again, I'll use that example, best if you want to get a $1 bank account in El Salvador, good luck. I mean, it's not going to happen. So your options are far narrower, and that holds people back. Not just financial services people like us, but people just trying to run businesses, exporting sugar, importing oil. basic stuff.
So you see biggest opportunities in emerging markets?
Yeah, no question, because that's where the problem is that needs fixing. So, I'll give you another example. We were being onboarded by a tier 1 bank, and they said, as part of KYC, it's standard to say, where are your top markets? So say, where do you do 20% or more of your business? And we said, well, this country, this country, this country. And we listed 3 emerging market countries. And they said, oh, well, those are a bit risky. And you think,
Can imagine, yeah.
Yeah, but you think, well, hang on a minute. Who do you think I'm selling stablecoins to? I'm not selling it to the Swiss or the Norwegians. I mean, like, their financial system works kind of fine. I'm selling it to people who've got a major problem and are sitting there going, I can't get a dollar bank account, but I have to buy all this oil, all of these soybeans, or all of this sugar with US dollars. And how on earth am I supposed to do that if I can't get access to a dollar bank account?
Yeah.
It completely baffles me that people don't understand the context.
So it takes some time to explain them that,
It does, yeah, which is why podcasts like this are so useful.
Right. You mentioned Europe.
Yeah.
Now we work closely in Kazakhstan.
Yep.
You have experience in Middle East.
Yep.
And Europe is a kind of also big market and
Yep.
a lot of payments. And they just introduced a lot of local stablecoins and also Mika.
Yep.
How do you see the development of the market there?
Well, again, I think it's going to struggle, partly because the financial system in Europe largely doesn't really need fixing. Well, in the terms of payments, I mean, there's certainly the Capital Markets Union. I mean, every sort of couple of years they say, oh, we're going to reinvigorate this, and then nothing happens. It's sort of the usual story. But payments in the European Union, banking in the European Union sort of broadly works fine. Yeah, you can move money around pretty quickly, including if you get foreign currencies. It's doing euro to Polish, euro to Hungarian forint. It's kind of fine. So the demand is just not there compared with somewhere like Nigeria, Egypt, India, Turkey, and so on. So, I mean, our interesting, or at least I think it's interesting, statistic is obviously most of what we do is US dollar stablecoins. It's about 90%, something like that, 95. The biggest stablecoin that we trade in terms of currency is not the euro. It's not the pound. It's not the Canadian dollar. It's not the Swiss franc. It's the Turkish lira. So first half of this year, we did about $36 billion worth of dollars. We did about $3 billion of Turkish lira stablecoins, which seems completely counterintuitive. Why would you have a stable coin against a currency that is inherently unstable? It's got a lot of volatility. And there's a few reasons for that, but it's all things that I've sort of listed. It's a little bit harder to get a Turkish lira bank account than it is to get a euro bank account. The payment system is not quite as efficient. The big ones are, if I want to have an offshore Turkish lira bank account, let's say I'm in Singapore and I'm importing boron or something from Turkey. Turkey's weirdly one of the biggest exporters of boron in the world, nuclear power stations. I can't get a Turkish lira bank account, at least not easily. Turkish lira also has sort of limited settlement windows. But then beyond that, Turkey has very young population, very forward thinking. It's got a fabulous financial services sector. It's got crypto regulation, and the banks provide services to crypto. So tick, 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 those 3 things I sort of highlighted earlier. So as a result, Turkish lira stablecoins are much more in demand because so many people are using stablecoins and trading crypto in Turkey. It's no good using Turkish lira because, as with all cash, it's not as fast. So use Turkish lira stablecoins instead, and then move just as quick. So I think, again, counterintuitively, the opportunities in stablecoins particularly are going to be outside of the G10, outside of Swiss, Canadian, and so on. It's going to be Mexico, it's going to be Nigeria, it's going to be Kenya, it's going to be Malaysia, Indonesia, Ukraine potentially. Ukraine has got one of the highest adoption rates of crypto in the world, particularly stablecoins.
Since almost the beginning.
Exactly. Yeah. And again, what's the recipe? Young population, educated population, forward-thinking, technology, up for technology. Obviously, you've now got huge diaspora, people sending money home and receiving money. You have a lot of the ingredients to create a thriving fintech and digital asset sector.
Yeah, good to hear that, because I think that when people also are, as you said, a lot of people are outside of Ukraine right now. Yeah. It seems like they are more willing to accept something new, which helps them, to survive, to develop.
Yeah.
So they will be more willing also to onboard with something, to test something.
Yeah.
You know, not using Western Union for money remittance, but try to send money with stablecoins if they have the infrastructure and understanding. So that it seems to be like the future. So
well, they say necessity is the mother of invention.
Right. Exactly.
So yeah, it's for a negative reason, but a positive outcome.
Yeah.
And the positive result is going to be that in the future, the Ukraine and Turkey and places like that are going to have these ecosystems that they're going to be able to then sell to the rest of the world. And I think the other thing that, as someone born in the UK, I would love the UK to understand is that if you're operating in a digital environment is infinitely scalable. So it's no longer the case that you have to have a big city, you have to have New York, or you have to have London, or you have to have Singapore or Hong Kong in order to be a major financial center. You can be a major financial center anywhere if you can digitize and scale the whole thing. What do you need? You need developers. Those can be distributed now. You hire developers all over the world. You can have sales teams. They're distributed all over the world, and so on and so on. It's no longer the case that I'm a big city, therefore I will win. I think you can have small jurisdictions. Where would I call out? Mauritius, I would certainly call out. Bermuda, again, Ukraine, the United Arab Emirates, as potential winners in the future ecosystem because you can scale infinitely.
Yeah. How do you think you can earn on those markets? Is it about the fees which you apply to when you send the stable coins, or it's a FX business again? Like, how do you see actually the business
I think
stablecoins?
I think you can be a lot more creative now in terms of the business model. So fee income, like foreign exchange or just service fees and all those sorts of things, withdrawal fees, and so on. I think the days of sort of net interest margin are starting to unravel. This is a personal view, but if you look back to the 1930s, the Americans had something called the Chicago Plan. And the Chicago Plan effectively said that we'll have two monetary systems. We will have one where we are moving value, making payments, and that will be backed by central bank money. So it'll be 100% backed, completely reliable. And then on the other side, you'll have the credit creation system where you can increase and decrease the money supply. You can do that, but the two are fundamentally distinct. What we wound up with is a merger of the two. So you have the fractional reserve banking system where you also do payments. So if I hold a deposit in a bank, I've actually lent the money to the bank. So if the bank goes bang, all I get back is whatever is protected by the deposit guarantee scheme. So in the UK, it's whatever it is, like £85,000. I'm probably out of date. But you've mixed the two. So I think with stablecoins, and in the future, you're going to start to divide the two again, and there is this separately, which then speaks to two different charging models. One's going to make money by return, the time value of money, effectively the price of time. And on the other side, it's going to be fees and things like that.
Because sorry to interrupt,
please.
Because it seems that everyone is expecting that payments with stablecoins would be much cheaper or almost free, because no one, when you try to apply some fees, they see it like it's stablecoins. They should be free or something. They should, the receiver should have it in 1 minute. It has to be almost free. So that I'm asking that because you have to also think of other business models where you can earn money, since people are expecting those things to be cheaper.
Well, you have the net interest margin which the stablecoin issuer is tending to keep. So that's similar to central bank seigniorage, where a central bank would print money. That's effectively written an interest-free loan to the central bank, and the central bank earns seigniorage. It's effectively a form of sort of interest margin. That's what Tether and Circle do. So they've issued tokens that don't pay any interest, and they're keeping all the interest on the back end. Now there's some hybrid versions. There's coins that pay sort of bounties, Agora. There's the Paxos one, the digital USDG. I can remember the full term that they give to it. They have USDL, yield dollar, and so on and so on. The distinction there, and this is one of the criticisms that you often get of digital assets, and particularly stablecoins, particularly from some of the writers at the European Central Bank and the Bank for International Settlements, some of whose papers are, they're embarrassingly bad. Let's say, for example, I have fiat money. Okay, so that is effectively par value. Okay, because you have the three definitions of money. the three characteristics of money, sorry. So that doesn't fluctuate. So that's fixed. If you then have transfer costs of 5%, okay, whether that's explicit costs or implicit costs because it takes so long to transfer, then that's your all-in cost. Now, if you have a stable coin that fluctuates on the secondary market, let's say it fluctuates by, let's be really generous, 50 basis points, okay? But in practice, it's more like 10. Let's say it's 50. But the settlement is instant and the fees are minimal to make the transfer, to your point. Let's say it costs, I don't know, 5 basis points. So 55 basis points is what it's charged. That's a lot better than, that's 445 basis points better than what's being charged with fiat currency. Yeah. So it doesn't matter that it fluctuates slightly. And I would argue that it doesn't fluctuate at all if you have a direct line like we do to all of the stablecoin issuers, because I'll just go and mint and burn it at 1-to-1. So yeah, it doesn't have to be at par value necessarily to be cheaper. And this is the thing that I think a lot of those writers and those critics don't understand. My impression is because most of them, I would guess, come from the neoclassical school of economics. The classical school of economics don't really seem to get context. So let's say you're on you're a beach on a hot day, right? I give you 2 bottles of Heineken. One of them's been sitting in the sun and is warm, and the other has just come out of a freezer. Which one are you going to choose? The cold one,
yeah, probably.
Obviously. But a classical economist will go, well, they're the same beer. They're not. It's a hot day. It's a cold drink. It's clear which one you would pay more for. Context matters in terms of value. So if you can send something faster, more reliably, with less psychological costs and lower all-in costs on a probabilistic space, then it's very, very compelling to shift away from fiat currencies and the correspondent banking system.
Good answer.
Thank you.
What biggest challenge you solved for your customer with stablecoins so far?
Lack of familiarity. So one of my favorite sort of catchphrases that we came up with, I came up with it, so I'm quite fond of it, is making the unfamiliar familiar. So stablecoins are not familiar, digital assets are not familiar, blockchains are not familiar. So we try to approach our customers who are completely new to this by trying to make this as easy and intuitive to understand, by making sure that they don't feel stupid. You know, and they ask questions that many people will go, oh, you know nothing. It's fine. I'll just accept that you know nothing, and we'll teach you. Don't worry, and don't feel bad. No question is a bad question. The fact that you're interested is enough for me. Whereas I think a lot of the crypto industry does itself a disservice by not understanding how to sort of approach people. I think quite a lot of the crypto industry engages in, it's not my term, but I've heard it's referred to as measurebation. So being over fascinated by the technology. So the analogy would be, if I have a wristwatch, I don't wear wristwatches really. I have a wristwatch, it's got 12 diamonds in it. You can swim down to 100 meters. I mean, obviously that would crush my body like a Coke can, but the watch will still work, but it doesn't tell the time. So you can have people who are very, very excited. Oh, we have this DeFi protocol and it's amazing and it's incredibly sophisticated. And you go, well, okay, fine. But if I put 100 million into it, what will happen? Oh, it will break. All right. Well, that's that then. Or if I'm a bank, how am I going to be able to KYC that? Well, you can't. Okay, well, conversation's over. I think the digital asset and the crypto industry can get overexcited about the technology and not actually think about, well, what am I trying to fix? And sometimes the problems that you're trying to fix are so blindingly simple that they're staring you in the face. And yet you sit and listen to so many people at digital asset conferences. I did last week in Mexico. And they're just sort of saying, well, we're just looking for the real world use case. I have a shipbroker who has a very, very real world use case about buying and selling ships.
Tell me more about this.
I don't think I can because I'm under NDA and they're launching it. So I don't want to I don't want to ruin their parade. But very innovative. Came up with it after probably too much to drink in a restaurant in Greece with 2 of their brokers. But some of the stuff that we're seeing on the commodity side is very creative. I suppose the other thing, again, it's not my analogy, but let's say digital asset people would look at a doorman standing outside a hotel, right? And they would go, Well, we have technology that can fix that. We could fire the doorman and we'll put an automatic door in. Problem solved. What they don't realize is that the doorman actually does many other things. He makes the hotel look cool because it's got a very smart doorman out the front. He's also the person that if you're the tourist and you come out of the hotel and you don't know where to go and you just go, where's good to go for dinner? Where's safe? What's, is it worth going and seeing this museum? Oh, no, don't do that. Go to this one. That's what the doorman does. He does many other things beyond opening the door. And
Maybe some people will come there because they want to see him.
Exactly. Oh, yeah, that is exactly it. Oh, we'd like to stay in this hotel. The rooms are a bit naff, but I like Dave.
Yeah, he's so nice. Like he talks to you all the time and shares some local news. And
this is it.
So the best restaurants.
100%. So I fear that too many people in digital assets and crypto look at a doorman and just see a man who opens a door. And actually, there's a lot of value that someone like that can create. And also sometimes, you can reframe things. So again, it's not my example, but the early parts of this century, ships used to race across the Atlantic to see who could go across the fastest. That's one of the reasons why the Titanic sank, because they were going too fast, they hit an iceberg and they sank. Suddenly, aircraft are invented. Now you can fly across the Atlantic. So all of these ship owners are going, okay, what are we going to do? So now instead of emphasizing the speed of the ship, you turn it completely on its head and you emphasize
enjoy.
The ship goes really slowly, So
because you cannot compete anymore with that.
Exactly, you can't compete. So now change the game. And again, I don't think people in digital assets, actually in wholesale finance, are just as responsible. Understand, the context, really where value is created and where value is driven.
Yeah. How do you evaluate the level of competition in your sector?
It's a good question. We don't really have many competitors. We don't think. I could probably name 2 or 3 banks that are actually credible, that are large, to the tier 1, tier 2 banks, that are large, that have some sort of activity in digital assets. BTG Pactual, DBS, possibly SocGen Forge with their stablecoin.
But you compare yourself mostly to banks, right?
Well, there's 2 flavors. So I'll start with the banks. There's that lot. Then you've got the sort of the more evolved crypto houses that have access to foreign exchange in the same way that we do. Coinbase will be well up there. And then if I move on to OKX, on the institutional side, of course. So we don't do retail, very much on the institutional side. And then you've got the liquidity providers. So, the ones I would definitely single out there would be, Cumberland, no question at all. Sort of one of the market leaders in terms of market making and expertise in traditional finance. So do we see them as competitors? In some places, or B2C2 is another one.
Yeah.
So if I made a Venn diagram of us and them, there is definitely overlap. But I would argue that there is far more open space between, outside of the overlap, where we are not competitors. And actually, I would see that we're much more collaborators and partners, because our competition, going right back to the beginning, is with the correspondent banking system, and with traditional finance, which operates T+1, T+2, doesn't work at weekends, doesn't work after 5 o'clock at night in many cases, costs a huge amount, and is becoming increasingly unreliable in a large number of jurisdictions, particularly in
so that's how you different
markets.
Right?
That's how I would think about it. Yeah.
And if we talk about liquidity providers, do you directly compete with them, or they lack some infrastructure, let's say, like banks or?
Yes and no. So by virtue of our relationship with Standard Chartered, we have access to domestic bank accounts that are directly connected to domestic clearing. So let's say, for example, you have a bank account with, a bank in Liechtenstein, which provides you a Polish zloty bank account. Unfortunately, that bank is not a direct clearer, so they go to one of the Polish clearers, M Bank, for the sake of argument, let's pretend it's them. So your instruction goes to one bank, then goes to another bank, then goes to the government system. Ours is different. We don't have the Liechtenstein bank. We're just going directly to a domestic clearer, which in many cases is Standard Chartered, and straight to the government system. So the distance between us and the government system that moves the money is narrower than from everyone else. Government systems usually come in 2 flavors, wholesale and retail. Most of those banks, like the little Liechtenstein one that I mentioned, or the PS, the payment service provider, will have access to real-time payments, so retail. So if I get my phone out and I want to send you some pounds, it will probably move across UK faster payments and it'll go straight to you. But it's usually capped at a maximum of £100,000 a day, something like that. Now, if someone turns up with a tanker of crude oil that's worth 60, 70 million pounds, you're going to look quite stupid, or I'm going to look quite stupid, paying for that £100,000 at a time. It's going to take me a while. 700 transactions or something. It'll take a fair while. So instead, you use the wholesale systems, which are not quite as fast, not quite as available as those faster payment systems, but they're bigger. So I could just pay for that tanker of crude oil in a single payment and I'm done, which is what we specialize in. Most crypto companies still struggle to get access to those wholesale government systems. Or if they do have access, it's indirect. So they're going through one bank to another bank and then getting there. In addition, we've been able to get access to domestic clearing in a very broad variety of currencies. So most of our competitors might be able to crack it in dollars, euros, maybe pounds, possibly Swiss francs, and then it kind of dries up.
It will require years, like it will take years just to get same currencies. Yeah.
We have CNH, we have offshore Chinese renminbi, we have Australian dollars, we have Philippine pesos, we have Mauritian rupees. So we have, South African rand. We have a much longer tail or much greater selection of currencies that we're making available to our customers. And all we're trying to do is just to try to make that cross-border movement of value that much more efficient and doing it in a compliant and responsible, safe and sound manner.
So you have some number of customers right now, active customers.
About 230, 240, something
200, like that. That's more than 200.
Yeah, it's over 200, yeah.
So when you talk to them and when you solve their questions and problems and challenges, and they provide some feedbacks, how it impacts your strategy in your company. Like you listen to them, you have a lot of customer development. We have some strategy for like 5-10 years and it helps you, but still you're going your way.
Yeah, one of the favorite sayings that the British Army uses is the first casualty in any engagement with the enemy is the plan. So you have a plan, and I'm not saying our customers are the enemy, far from it. But the moment you engage with a customer, suddenly you think, okay, my plan is out the window. What I thought was a good idea is suddenly not something we should pursue. So I'll give you an illustration. When we first commercially launched in September 2022, we offered brokerage, which is what we do today, and an exchange. So we had a central limit order book, a little bit like a Coinbase or a Kraken or a Binance or something like that, where clients and liquidity providers could come in, post prices and trade with each other. We offered 2 stablecoins, 3 fiat currencies, dollars, sterling and euros, and about 10 digital assets. And we really struggled. We thought we're bank backed, we do KYC CDD the correct way, we're good counterparty credit risk, we're regulatory first, and we segregate the activity of what we do, which is execution, brokerage and exchange, from custody. It's safe to say that no one in crypto cared. In fact, we had a couple of people who were actively hostile to us. Oh, you're a bank, we hate banks, smash the system. You're like, okay, so you're not going to onboard? No, I mean, they're literally death to the banks. I'm like, right. So we struggled. We also launched against the backdrop of Three Arrows Capital, Terra Luna, Celsius, Voyager Digital, and all the other ones I can't remember. Then FTX happened in the November. Sam Bankman-Fried blew that up. And then in March 2023, we had Silicon Valley Signature and Silvergate Bank blew up. We actually were a customer of Signature Banks. We managed to get $2 million out the weekend just before they went bang.
And I think, money is one question, and then try to get back to your work, and all this reputation of crypto on the market was another challenge also to solve.
Exactly. So 2 things happened. Was almost with FTX, a lot of the crypto companies discovered counterparty risk and went, actually, the fact you're owned by a bank sounds actually like quite a good thing now. Could we open accounts? Yeah, sure. Oh, well, we're not really doing much business, by the way, because we've got 15, 20, 30% of our assets are stuck in FTX. So we wound up onboarding quite a lot of clients that for a long time just didn't do anything because they didn't have any money. And then a lot of the traditional companies that we were speaking to, so that Standard Chartered introduced us to, particularly hedge funds and asset managers, just looked at the crypto market and went, this market is insane. We'll come back in 5 years when this has all calmed down. But the collapse of the 3 banks caused 2 of our clients to be completely debanked. They lost all banking rails. And it led to certainly me having an epiphany. I remember I was at a conference, bored out of my mind. And the epiphany was that if our crypto customers struggled to get access to basic banking, what was their access to foreign exchange like? And we did an informal survey, and it was beyond terrible. One of our story I quite like. One of our customers, based in the Middle East, was paying their local bank 4% for dollar dirhams. You can get better rates at the airport if you go and do it in cash with your credit card. I mean, it's just terrible. So we then spent the rest of the year, we explained it to our board, got the strategy change, spent the rest of the year opening the bank accounts, connecting to the foreign exchange, and working out how to get the fiat to go faster. But what I'm describing there is we started with a plan. The plan was well-meaning, well thought through, but the moment we got into contact with reality, which was the crypto market, scandals everywhere, banks collapsing, suddenly you sit back and go, okay, the opportunity is in foreign exchange, particularly against stablecoins. January 2024, we closed the exchange. The code is still there, just doesn't do anything. And we've just focused on the brokerage, and we focus very much on stablecoins versus foreign exchange. So it's all good having a plan, and you should have a plan. But if you come into contact with the enemy and the plan is there dead on the floor, you need a new plan.
Yeah. So those 200 plus institutional customers, what they are asking for the most today? Is it like liquidity, better settlement speed, or management, or something else?
It's all of the above. So they're looking for lower costs. That's the explicit cost. They're looking for higher speed, which is the implicit cost. And they're looking for reliability, which is the psychological cost. Those are the 3 things they want. There are obviously other things. I mean, everyone wants a better price all the time. So, haggling with a customer is always great fun. They want credit lines. So they want us to settle first because some of them are balance sheet constrained, and up to a point we can do a credit analysis. We can do that, and we can be creative. All of them pretty much ask for third-party payments, which is why that's a key focus. And then a subcategory of them are asking for collateralized lending. So they have Bitcoin, they want to borrow dollars or stablecoins. So that's a business that we've just launched, really at test sizes, and we're looking to scale that up. Our client base, I would say, broadly splits sort of 80-85% of it is VASPs, so it's crypto companies who are managing their foreign exchange with us. It's payment companies, cross-border payments, remittances, payments companies like yourselves who are using us for periodic rebalancing or using us for foreign exchange. We have a little bit in the NGO space, so development organizations. In fact, we've got one that's public, Great Ormond Street Hospital here in London.
They're onboarded already, yeah?
They're a client, yeah, it's public. So they get crypto donations, and they liquidate those donations. Well, we liquidate those donations for them into sterling or dollars. I can't remember, it's one of the 2. I think it's sterling. That's a source of huge pride to me because my oldest boy is an outpatient at Great Ormond Street. So he has a, excuse me, sorry, my children. So he has a cleft palate. He was born with a cleft palate, and he's an outpatient at Great Ormond Street. So very proud.
Wow.
That they're our customer.
Yeah.
God, sorry, you're pathetic. When you have children, you become a lot more emotional. Anyway, the others are primarily commodity companies, maritime, things like that, and they're using stablecoins for cross-border payments. But yeah, if I had to pick a favorite, my favorite customer is Great Ormond Street.
Wow. So a lot of use cases actually you have.
Yeah.
So what do you think is the biggest challenge for you in further development? Like what you have to overcome to succeed?
So I think, scaling the business. So it's a balance sheet intensive business. If you are moving to a situation where money in value is moving very quickly, so you're removing or reducing counterparty credit risk. So you and I do a trade, you owe me money, I owe you stablecoins. Are you going to pay me? Am I going to pay you? That's counterparty credit risk. One of us has to go first. Let's say I deliver stablecoins to you. You could run away, you could go bankrupt. So that's what we have to control. The faster we settle, the less that risk becomes. However, the problem that creates is that causes counterparty risk to go down, but it causes something called capital and liquidity risk to go up, because we have to find the money to fund the delivery of our trades. And we have to be much, much faster at doing that. In foreign exchange, you might be, or other asset classes, you have 2 business days to do that funding. So you have a nice bit of warning, and you can also net off your activity. You might have some purchases as well as sales. You net them off and you reduce the amount you have to settle. With digital assets, that goes away. So that means it's more balance sheet intensive. So we need loans and we need capital. So that's a problem. We need more currencies because there are lots of markets that people want us to serve. The challenge is we're moving into currencies that are more and more restricted. Capital controls, foreign exchange controls, which we honor, and we stick to those currency controls. But then nevertheless, there are still people who want to buy hryvnia, who want to buy Nigerian nairas, who want to buy Brazilian reals. So that's a big challenge. I think also still navigating the big bank. Big bank is still a big bank. It still comes with politics and complexity. So that still needs a degree of management. And last but not least, we're also now trying to create relationships with other big banks.
Yep.
Because Standard Chartered is not everywhere. It can't be. So there are some other regional banks. There's one in Eastern Europe that I think very highly of, which has presence in Ukraine. So I'm quite excited that might get us there. There's another one in Sub-Saharan Africa that does countries that Standard Chartered doesn't do. There's another one in Brazil. There's another one in Mexico. So trying to forge those relationships, it's going to get tricky because it just means more banks, more bureaucracy, more committees.
More onboardings.
More onboarding, exactly.
And policies.
And more time zones as well. So I'm going to get less sleep. So if I have to deal with, heaven forbid, I get an Australian bank or a Singaporean bank or a Japanese bank.
Maybe at some point we have to switch and try to invent the teleports and then continue the businesses.
Yeah, exactly.
So that we can sleep more.
I'll be in 2 places at once.
Yeah. Do you have any conflict of interest when you try to... So you are a part of the big bank.
Yeah.
You go to another Taiwan bank.
Yep.
Do you have any conflict of interest? Like maybe they see some, I don't know, some danger or something. They how easy is to talk to them?
It's a good question. I mean, again, you make that Venn diagram, so the circles of influence, and there's going to be overlaps. So the Eastern European bank that we're speaking to, they do euros. Standard Chartered does euros. So there's an overlap. But these other guys, they do Romanian lei, they do Serbian dinars, they do the other currencies that Standard Chartered does not do. So, and Standard Chartered knows that, and we try to pick banks that already have a relationship of some shape or form with Standard Chartered. That way, we're a known quantity. These other banks look at us in a Standard Chartered context, and we try to play to the strengths that we have rather than just turning up, to some unknown bank and just sort of winging it, just doing our best. In terms of conflicts, I mean, there are also conflicts with other parts of the bank itself. Standard Chartered does correspondent banking. There is an argument that stablecoins are going to eat part of that lunch.
Yes.
So you have to sort of figure out, okay, well, what are the opportunities? So I'll give you an illustration. We've got say you have a commodities client that is also a client of Standard Chartered's that's onboarding with us. We say to them, who do you bank with? They say, well, we bank with Standard Chartered and JP Morgan. We go, okay, fine. If you're going to buy and sell stablecoins with us, we can't advise you, but we would recommend. We think it's, from an infrastructure perspective, here is why it's a good idea, to use your Standard Chartered bank accounts to settle with us. The answer, when I first did this, they said, oh, is that a compliance reason? I said, no. It means that when you're sending cash to us or we're sending cash to you, it's a book transfer across the bank, which means it can move nearly, well, in most cases 24/7. It can move at weekends. It'll move very quickly. Whereas if you send money from JP Morgan to us, it's going to go across SWIFT and it's going to be slower. It's as simple as that. And I said, well, and if you don't have bank accounts in the right places in Standard Chartered, then the relationship manager who's sitting next to me from Standard Chartered, who is licensed to sell this to you, can set everything up. So what we're trying to do is to demonstrate where those parts of the bank that might lose out in some places can actually gain in more places. And I think that's the key, because you try to make sure that it's not a zero-sum game. You know, I want everyone to flourish. I want everyone to get rich.
Yeah.
You know.
So whenever you have this all fiat operations done in one bank, you have like overall experience is better because you have, as you mentioned, you know, this instant settlement, compliance is, you know, you don't have it basically already. Correct. If you have money inside. So aren't those banks afraid that eventually, because you have better technology or you you have some innovations which you can offer, aren't they afraid that, you know, you can take some customers at the end? And how do you answer?
Standard Chartered probably isn't, because we're going to deepen existing relationships with existing customers, and we're hopefully going to win them some new customers. I mean, they don't want all customers because there's some jurisdictions we serve that they don't. There are some clients that are too small for the parts of Standard Chartered. But fundamentally, we try to find, you know, a happy overlap. But to your point, some of those banks that are still fingers in their ears, shouting that it's, oh, digital assets is all money laundering and illicit finance. Yeah, fine, that's your view. But I think they're going to find in a few years that they're going to go the same way as the ICE industry.
So more time, and eventually.
Exactly. There are lots of industries in, you know, human history that have disappeared.
Yeah.
You look at the amount of infrastructure in this city, for example, that was designed to accommodate horses. We don't have horses anymore on the street, or at least not like we used to. Or, I mean, my favorite of mine is the ice industry. There used to be a whole industry with a futures market where ships would sail to Norway or to Canada, mine ice, and then sail the ice to Cairo or Buenos Aires. And that's how your ice would come pre-refrigeration.
I was going to mention a few times Kodak also with, you know, with cameras and
Kodak,
pixels, right?
Switchboards, you know, for telephony. Yeah, I mean, all of these industries have died. So it's not necessarily the industry, but it's the industry practitioner.
Yeah.
And if they don't recognize that the industry is moving without them and they're not on the bandwagon, then, you know, I don't really have any sympathy, to be perfectly honest.
So whenever new technology develops, new business opportunities often emerge.
Yeah.
So you think with this rapid development of stablecoins, what kind of like new additional services or revenue streams might become possible?
I think the simplest one for me is the opportunity to have money on the open internet. So you can have a representation of money in an app or in the browser. Because at the moment, money is not in the app and is not in the browser. There are gateways that will take you from the browser and the app to the payment system, whether that's a credit card payment system, a faster payment system, a government payment system, or whatever. There is a gateway between the two because it's not internet-based and the other is. So I think bridging that gap is huge. The second is to have asset classes coexisting on the same infrastructure as money. And I don't necessarily just mean financial asset classes in the sense of bonds or carbon credits, private credit, whatever. The one I'm more excited about is trade assets. So the trade industry, the cross-border shipping and trade industry, has already had multiple failed initiatives to digitize everything that they do, whether that was blockchains or some other form of digitization. So TradeLens, Marco Polo, Contour, Serai, and a bunch of others. A lot of them were built on things like IBM Hyperledger and R3 Corda, which are sort of generally permissioned systems or closed systems. And also they focused on trade finance, or they tended to focus on trade finance, rather than the foundational part of trade, cargo, money. One of the big things that they would have struggled with is that money can't interact with the cargo, can't interact with the trade documents because, as we've said, money is not on the open internet. So if you can get to a point where you have money, stablecoins on Ethereum, for example, and you have a bill of lading that represents a load of iron ore on a ship on Ethereum, suddenly they can talk to each other.
So basically you tokenize as much as possible documents, procedures, so that you can match it and you don't have delays of some systems.
You don't have delays. And as much as everything we're describing is bringing financial services from the 20th century into the 21st century in many ways, I would argue that there's large parts of the cross-border trade industry they're in the 18th century. You sort of talk with some of these guys and you say, excuse me, how do you move bills of lading? And the guy will go, man on a motorbike, and you sort of think, is he going to start laughing? Wait, he's serious? Yeah, man on a motorbike. Will drive away and take the bill of lading and physically deliver it to someone. If they're going to get very advanced, they may use a fax machine. And you realize, oh my God, this industry is still in the dark ages. So being able to bring them through, and frankly, every country in the world has some sort of cross-border trade, legitimate or illegitimate. I was trying to think of any exceptions, and North Korea sprang to mind. But almost every country, if not every country, has cross-border trade. So if you can bring efficiencies to that and get that to interact properly with finance, then I think that's going to be huge. Longer term, I think the opportunity is in intellectual property. So let's say, for example, you invent a video game, Sonic the Hedgehog. You can copyright the code base. You can trademark Sonic. Now, if you can tokenize those and then make every payment to download that video game be paid in a stablecoin, then you can link the stream of cash flows to the intellectual property in that video game. Now you can recognize the cash flows, you can value the intellectual property based on current cash flows, and potentially you could lend money against the intellectual property that's there. At the moment, if you look at the way that, say, for example, Standard Chartered has a list of acceptable types of collateral. I could take your house, you could give me treasuries, you could put dollars into a bank account, you give me bonds, all sorts of stuff. Intellectual property is not on that list. And if you look at more and more of the companies in the world, admittedly a lot of them don't need cash, but if you look at a lot of companies in the world, they are more and more intellectual property heavy. They don't have people, plant, machinery that they can borrow against necessarily. They don't have ships and physical assets. I mean, Coinbase, for example, doesn't even have an office. It's all sort of WeWorks and rented stuff. They don't have buildings. So you can go, okay, well, I can lend against your head office building. Doesn't work. So there's more and more of the world's economy is invisible to the banking system. How can you lend money against something you cannot see? And that's going to be an increasing problem. I suspect that's why venture capital and private equity, or venture capital particularly, has seen such a rise, because they can lend against intellectual property, whereas a bank, I think, struggles.
Yeah.
So that for me that's a huge opportunity.
Yeah, a lot of insights basically for entrepreneurs.
Yeah.
And last question, which is a bit more private, I would say.
Go for it.
And especially we have some young entrepreneurs who are watching us.
Oh, yeah.
So the question is, how did you earn your first $1,000, $10,000, and $100,000?
That's a very good question. Okay, first $1,000. So was it 100,000? Say the numbers.
Yeah,
again?
1,000, 10,000.
Okay. So first 1,000 was working in bars. Possibly, I worked in a garden centre. I don't know how much I earned. I used to do 1 day a week at weekends.
Do you remember the age? Like
I would have been 14.
14.
Yeah, so I was 14 working in a garden centre, which I loved. It was a great job. Outdoors, digging, you know, planting things. That was lovely. Working in bars at university, so I started that when I was 18. And that was a great job. That was a hobby. So that's probably the 1,000. 10,000 I earned as a door-to-door salesman in America, which was comfortably the hardest job I've ever done. The army was easy compared with that. That was selling children's books, study guides, and encyclopedias in the Pacific Northwest in America.
You were, how old were you?
I was probably 20,
20.
maybe 21, something like that. 100,000, yeah, would have been at Standard Chartered.
Standard Chartered.
I couldn't tell you which year. Probably, I don't know, probably, I must have been late 20s, maybe early 30s, something like that.
Yeah.
That would be my suspicion. But favourite job, apart from what I'm doing now, of course, working in bars. I liked working in bars. And the army, pardon me.
What was so special about it?
Well, the army, just because you're surrounded by like-minded people all the time, and it is an incredibly funny environment. Also, you just get to do sport all the time, and
a lot of benefits, right, beside the work.
Yeah, you've got friends who will genuinely lay down their lives for you, which is quite emotional. I mean, I didn't spend that long in the army. I was never deployed. I was medically discharged. But I met some very, very impressive people. And even just for the short time I was there, you have a real sense of camaraderie and bonding, which was very, very special. In bars, you're just seeing your friends out, except you were on one side of the bar and they were on the other. So you're still hanging out with your friends. It was great fun.
So it seems like a lot of those things which you enjoyed were connected with this atmosphere which you have and you had, in the company. Or
yeah, I mean, I try to approach everything I do with humor as much as I can. I don't really. There are times for seriousness, but wherever you can, try to insert humor and try to enjoy yourself, because otherwise, what's the point? What would I do after this? I would run a cycle touring company. So I love cycling. So a few friends and I, once we've managed to educate our children, we're going to run a bicycle touring company. So we'll help people, go and explore parts of the world on bikes.
Good. I remember you mentioned that you were running and preparing yourself to the marathon.
Yeah, I have the Budapest Marathon in about
accomplished that?
a month. I know it's in a month's time.
In a month's time?
Yeah, so it'll be my 6th marathon.
So you're still preparing now?
Yeah, I went running, losing track of the days. I landed this morning. Yeah, I went running yesterday afternoon in a park in Sweden, which was beautiful. So if a little bit humid, but I'm still training for that.
Yeah, good luck with that also, with the marathon.
Thank you very much. Yeah.
So Nick, thank you very much for this conversation. A lot of
Pleasure.
Deep insights, and I think you are one of the most professional persons I could even imagine in this new era of stablecoins and payments. Especially you have this experience, which you gained in the bank, and then you moved to a digital assets sector.
Yeah.
And I'm sure it would be super useful to people who watched us. And thank you very much.
It's been a privilege. Дякую.
Дякую.